Ever feel like your finances are on a roller coaster ride and you're not quite sure who's controlling the speed? One minute you feel like you're soaring, the next maybe plummeting a bit, and you just want to brace for impact or, maybe even avoid those big drops altogether. Well, get ready to strap in because today we're embarking on, well, a really interesting deep dive into something that touches every single part of our financial lives, whether we realize it or not: financial risk management. It's sort of the art and science of navigating those ups and downs with hopefully a lot more confidence.
That's absolutely right. Our mission today really is to take a good, hard look at how we can understand and measure and maybe even, control some of those unexpected twists and turns in the financial world. And this isn't just for the Wall Street pros, right? It's about making sense of the variability in returns, thinking about how interest rate shifts can impact your mortgage or, say, the cost of borrowing for your business, even how those global currency fluctuations can subtly change the cost of your morning coffee if, those beans are imported. So we've gathered a really fantastic stack of insights we're drawing directly from our sources in 1.2 financialriskmanagement.txt. Our goal is to pull out the most important nuggets of knowledge, really, to help you feel well-informed and, maybe more importantly, truly ready to tackle financial uncertainty with a clearer head.
I'm already hooked. Okay, expert, let's just jump right into it then. So, to kick things off, let's start with the absolute basics. When we talk about risk and return in finance, people often have this gut feeling, right, about what those words mean. But what's the common misconception, maybe, or the nuance that we really need to get straight right from the start?
That's a brilliant way to frame it, actually. Most people, they instinctively know risk means danger or loss, and return means, well, what you get back. But in finance, we get a bit more precise. Let's start with risk. Formally, sure, it's defined as the chance of financial loss. But to really grasp it, maybe think of it as the variability of returns associated with a given asset. It's not just about losing money, see. It's about the unexpected swings. How much can its value go up or down? That unpredictability, that's the risk.
Ah, okay. So it's the wobble, not just the drop.
Exactly. The wobble. Now, return is, it's simpler. It really is the total gain or loss you experience as the owner of an asset over a given period. So you put money into something. What did you get back, positive or negative, by the end of it? That's your return. Pretty straightforward. And here's where the absolutely crucial relationship, the trade-off, comes in. Typically, greater risk yields greater returns. This isn't just a saying. It's like a fundamental principle of how financial markets actually work.
Okay, but why? Why is that the case?
Right. Because the seller of financial securities, or the entity asking you to put your money at risk, they have to compensate you, the buyer, for taking on that increased risk. They do this by offering a higher potential rate of return. If something is super risky, well, you better be getting a chance at a much bigger payoff, right?
Makes sense. Otherwise, why bother?
Exactly. Why would you bother? It's the market's fundamental way of sort of incentivizing you to step into that uncertainty. And this trade-off, it's absolutely crucial for you. It doesn't matter if you're a seasoned investor or just starting to think about saving for retirement. It's the core principle behind almost every single investment decision. Understanding it helps you evaluate any opportunity, really, and decide if the potential reward is truly worth the potential wobble, the variability, and chance of loss.
That makes so much sense. It's almost like the market is saying, okay, I'll pay you more, but yeah, you've got to earn it by facing more uncertainty. And here's where it gets really interesting because, as you said, not everyone looks at that risk-return trade-off the same way. What are the different attitudes people or, in the business world, managers have towards risk? Because I can tell you my attitude towards a roller coaster is very, very different from my friends.
That's a perfect analogy, actually. Just like people have different comfort levels with roller coasters, financial managers and investors have varying attitudes toward risk. Our sources highlight 3 basic risk preference behaviors that are really important to distinguish. First, we have risk-indifferent behavior. Now imagine someone who literally doesn't care if they walk across a tightrope 2 feet off the ground or, 200 feet up. As long as the reward, let's say a delicious sandwich, is exactly the same. In finance, this means an increase in the level of risk does not change management's required rate of return. They're just indifferent to the risk level. Their minimum expectation for compensation stays the same.
That sounds unusual for finance.
It is. Quite rare in serious financial management, yes. Then there's risk-averse behavior. This is probably the most common and, frankly, the most rational attitude you'll find. This is where an increase in risk does require an increase in the desired rate of return.
Okay, this is the pay me more for the higher tightrope person.
Exactly. If you're going to make me walk that 200-foot tightrope instead of the 2-foot one, you better pay me a lot more. Risk-averse managers need higher expected returns to compensate for taking on greater risk. This is a really key takeaway. Most managers are risk-averse. And this preference, it profoundly shapes financial decisions. It drives the demand for higher compensation for riskier ventures. Finally, we have risk-seeking behavior. This is, well, the opposite of risk-averse. It reflects an attitude where an increase in the level of risk actually results in a decrease in the required rate of return.
Wait, a decrease, so they want less return for more risk?
It sounds counterintuitive, right?
Yeah.
But yeah, risk-seeking managers are willing to settle for lower expected returns as the level of risk increases. They might actively pursue higher risk situations even if the potential return isn't proportionally higher. This is the person who just loves the thrill of the high tightrope so much, they do it even if the pay was the same, or maybe even a little less, just for the excitement, the challenge.
Wow, okay. So
Yeah,
you see this maybe in very speculative areas.
exactly. Less common for professional managers handling other people's money, perhaps. But you might see it in certain entrepreneurial endeavors or highly speculative investments.
Fascinating. So if most professional managers are risk averse, what does that tell us about maybe the common pitfalls amateur investors might fall into by being too risk seeking, maybe, or just not understanding that fundamental trade off?
That's a great question. It often means amateur investors, without a clear understanding of this compensation mechanism, might end up chasing high-risk, low-reward opportunities, simply because they see the thrill or the potential for rapid gains without fully appreciating the underlying cost of that risk. It really highlights why understanding your own risk preference and how it aligns or doesn't align with market realities is so incredibly vital.
Okay, now that we've got a broad understanding of what risk is and how different people approach it, let's get specific. So, what are the different categories of financial risk that businesses and investors actually face every day? It can't just be one giant bucket labeled risk, right?
You're exactly right. It's definitely not just one giant bucket. Financial risk management, it really involves capturing and measuring these multiple dimensions. Our sources lay out a pretty comprehensive list of risk exposures that businesses and investors are constantly grappling with. Things like interest rate risk, market risk, default risk, credit risk, liquidity risk, and price risk. Each one represents a distinct way that financial loss can occur or that returns can become variable.
Okay, let's unpack those. Where should we start?
Let's start with one that affects almost everyone with a mortgage or maybe a bond. Interest rate risk, sometimes called yield risk. This is simply the vulnerability of an investment's value to fluctuations caused by changes in interest rates. Think of it like this. If you locked in a low fixed rate mortgage years ago, and now interest rates are, skyrocketing, you're probably thrilled. Your mortgage payments are stable. But if you're a bank holding old bonds with low fixed returns, while new bonds are offering much higher rates, well, those old bonds are now worth less to a potential buyer. That's interest rate risk, the changing value of your financial assets or liabilities purely because of shifts in the broader interest rate environment.
Got it. Okay, what's next?
Next, we have market risk. This is often called systematic risk, or importantly, non-diversifiable risk. This is the big one, really. The
No.
exposure of a security or a whole firm to value fluctuations simply as a result of operating within the broader economy.
And non-diversifiable means?
It means it's inherent in the economy itself. You cannot eliminate it just by diversifying your investments. Think about major macroeconomic events, a global recession, a widespread war, significant inflation. These factors don't just hit one company, they tend to affect everyone in the market to some degree. You can't escape it by just picking different stocks. If the tide goes out, all boats feel it.
Right, the stuff you can't hide from.
Exactly. Now, in sharp contrast to that, we have unsystematic risk. This is also known as firm-specific risk, or crucially diversifiable risk. This is the portion of risk associated with random, unique causes that impact just a single firm or maybe a specific industry. And the key point is, this type of risk can be eliminated, or at least significantly reduced, through diversification.
Okay, so what causes this kind of risk?
Things like a strike in a particular company, a specific lawsuit against one firm, new regulations that only affect one industry, or maybe a business losing a key customer. These events hit specific companies or industries, not the whole economy. So you can spread your bets to lessen the impact. And to help keep these two broad categories clear, the ones you can diversify away And the ones you can't,
Mm-hmm.
our sources give us a handy little mnemonic, DUNS.
TUNS.
Yeah, DUNS.
Oh,
D is for diversifiable risk. U is for unsystematic risk. That's the non-market firm-specific kind. N is for non-diversifiable risk. S is for systematic risk, the market kind.
DUNS. Okay, diversifiable, unsystematic, non-diversifiable, systematic. Got it. That's actually helpful.
It is, right? Just a quick way to sort them out. Okay, moving on. There's credit risk. Now, this one primarily affects borrowers. It's a company's inability to secure financing or maybe get favorable credit terms, usually because of a poor credit rating. When a company's credit ratings decline, lenders, well, they demand higher interest rates, they might require collateral, and generally the loan terms become much less favorable.
Like your personal credit score affecting your mortgage rate.
Exactly the same principle, just for companies seeking capital. So credit risk is essentially about, can they get the loan on decent terms?
Yeah.
Now, closely related but distinct is default risk. This one affects the lenders. It's the possibility that debtors simply won't repay the principal or the interest due on their debt on time.
Ah, okay. So credit risk is about getting the loan. Default risk is about paying it back.
Precisely. The lender asking, will they actually pay it back as agreed?
Hmm.
Then we have liquidity risk. This affects investors and lenders. You're exposed to liquidity risk when you want to sell a security, but you can't do it quickly. Or you have to make significant price concessions, take a haircut just to get rid of it fast.
Like trying to sell a really obscure collectible versus selling Apple stock.
Perfect example. Trying to sell a rare antique painting versus shares of a major company. One is far, far more liquid. That difference is liquidity risk. How quickly can you turn something into cash without losing a chunk of its fair market value?
Makes sense. And the last one.
Finally, there's price risk. This represents the exposure investors have to a decline in the value of their individual securities, or maybe their entire portfolios. This can be due to factors unique to those individual investments, or it could be a broader concern tied to increased market volatility overall. Price risk is actually closely related to diversifiable or unsystematic risk, because many of those unique factors affecting an individual investment's price can, potentially, be diversified away in a broad portfolio.
Okay, so we've dissected all these different types of risks, big picture ones, very specific ones. But as we said, why do people take these risks? Why do companies borrow? Why do investors put money into the market? It's because of the potential for return. So once we factor in all these risks, how is this return actually calculated or expressed in the financial world? It can't just be as simple as what you got back minus what you put in, can it? Especially with all these nuances.
Precisely. Return is the compensation investors and creditors get for assuming risk. And yeah, as you touched on, it's not always just one straightforward number. Return is most often stated or measured by interest rates. For a debtor, right, interest is a cost, an expense. For an investor or lender, it's income. But there are several ways to look at these interest rates, and each one gives you a slightly different perspective on the true cost or the true benefit.
All right, let's break those down.
Let's start with the simplest one, the stated interest rate, sometimes called the nominal interest rate. This is just a rate of interest charged before any adjustment for compounding or other market factors. It's simply the rate you see printed on the loan document or the bond agreement. For example, a $10,000 promissory note says payments will be made quarterly at a 10% interest rate per annum. The stated rate, it's just 10%, what you see on the face of the document. Easy.
Okay, the sticker price, basically.
Kind of, yeah. But then we have the effective interest rate. This is where it gets a bit more, well, real. The effective interest rate represents the actual finance charge associated with borrowing, especially after you reduce the loan proceeds for any upfront charges and fees. It's all about the true cost to the borrower.
Ah, so like those origination fees banks charge.
Exactly. If you take out a loan with a 10% stated rate, but the bank also charges, say, an origination fee and maybe some documentary stamp fees that they take right out of the loan amount up front, well, you actually receive less cash than the stated $10,000 loan amount. That means your true borrowing cost, the effective rate, is actually going to be higher than 10%. Because you're paying interest on money you didn't fully get your hands on.
Right, that makes sense. So this shows the actual total cost.
Yes. It's important because it reflects the actual total cost of borrowing, beyond just the advertised rate. Next, there's the annual percentage rate, APR. This is a non-compounded version of the effective interest rate. And it's particularly important because it's the rate required for disclosure by federal regulations, especially for consumer loans. It's computed as the effective periodic interest rate multiplied by the number of periods in a year. The goal is to provide a standardized, comparable rate. So if a loan has an 8% stated rate, but interest is paid semi-annually and there's some upfront fees, the APR will give you a standardized figure, maybe 8.0 That accounts for those fees over the year.
So it helps you compare different loans more easily.
Exactly. It provides a clearer benchmark for comparison across different loan products.
Mhm.
Now, don't confuse that with the effective annual percentage rate, effective APR. Sometimes just called APR confusingly, but the key is effective.
Hmm.
This is the stated interest rate adjusted for the number of compounding periods per year.
Ah, compounding. This is where the magic happens, right? Or the pain, depending.
Huh, exactly. This is where the magic or the pain of compounding truly shows up. For instance, if you have an 8% stated rate that compounds semi-annually, the effective APR will be slightly higher, perhaps 8.16%. The formula itself is a bit much for audio, 1 plus IP1, but the core idea is simple. Interest is earning interest. So the true annual return, or the true annual cost, is higher than the simple stated rate because of that compounding effect.
And this is where your money starts making babies, for better or worse. Compounding is incredibly powerful, whether it's working for your savings or against you with credit card debt. It really is a double-edged sword.
Precisely. And to illustrate that further, let's briefly touch on the difference between simple and compound interest amounts. Simple interest amount is interest paid only on the original principal amount, no compounding. It's a flat calculation. So on a $10,000 note at 8% simple interest for 2 years, you'd earn a flat $1,600 in interest. That's $10,000 times zero point 0.08 times 2, always calculated on the initial amount.
Okay, straightforward.
Contrast that with compound interest amount. This is interest earnings, or expense, based on the original principal plus any unpaid interest that is accumulated. So interest compounds on itself, leading to a significantly higher total amount than simple interest over time. If that same $10,000 note at 8% were compounded annually for 2 years, the total you'd have at the end wouldn't be $11,600, it would be $11,664.
Ah, so that extra $64 is the interest earned on the first year's interest.
Exactly. That $64 might not seem like much on its own, but over many years and with larger sums, the difference becomes enormous. That's the power of compounding.
That's why your savings accounts hopefully compound, and it's also precisely why credit card debt can spiral out of control if you're only paying the minimums that interest is compounding on your previous interest. A really important distinction.
Indeed. And it leads us directly to the concept of the required rate of return. Investors and lenders, see, they don't just expect a basic return like the stated interest rate. They require additional compensation for the specific risks they're undertaking. This required rate of return is calculated by taking a base risk-free rate, so that the theoretical return on an investment with zero risk, and then adding various risk premiums on top of that.
Okay, so what are these premiums? What risks are they compensating for?
Let's break down the common ones. First, there's the maturity risk premium, MRP. This is compensation investors demand for being exposed to interest rate risk over a longer period of time. Simply put, the longer you tie up your money, the more uncertainty there is about future interest rates, so the higher the premium. Then, the purchasing power risk, or inflation premium, IP. This is compensation investors require to bear the risk that rising prices, inflation, will erode the purchasing power of their money over the investment period. If inflation is expected to be high, your money will buy less later, so you need to be compensated for that potential loss of value.
Makes sense. Keep up with inflation.
Right. Next, the liquidity risk premium, LP. This is additional compensation demanded for the risk that an investment can't be sold quickly without making significant price concessions. If it's hard to sell easily, you want a little extra reward for holding it. Think junk bonds, maybe? And finally, the default risk premium, DRP. This is additional compensation demanded for the risk that the issuer of the security, the borrower, will simply fail to pay the interest or the principal on time. Higher chance of default, higher premium required.
Okay, so you stack all these premiums onto a base rate.
Exactly. To illustrate how these all come together, let's consider a bank looking to purchase a corporate bond. Our sources give a great example where an 8% required rate of return is deemed appropriate for a specific bond issue. It starts with a real rate of return. This is like what you'd earn in a perfect no-risk, no-inflation world. Let's say that's 3%. To that, you add the inflation premium, IP, let's say 2%, to compensate for expected inflation. That brings the nominal rate of return, just the risk-free rate plus inflation, to 5%. Then on top of that, you add a risk premium of 3%. Now, this 3% specifically covers compensation for the interest rate risk, MRP, the liquidity risk, LP, and the default risk, DRP, associated with this specific bond. Adding it all up, 5% nominal rate plus the 2% risk premium gives you the total required rate of return of 8%. That's what the bank needs to feel adequately compensated for all the risks involved.
That's fascinating. It's such a clear picture of the expected compensation for all that inherent uncertainty. What stands out to you about how all these individual risks contribute directly to what an investor demands just to put their money into something?
Well, what's really fascinating here is just how nuanced it is, right? It's not just some single arbitrary number pulled out of thin air. It's a layered calculation. It attempts to systematically account for every identifiable risk. And it really forces both the investor and the issuer to confront the true cost of uncertainty in the transaction.
Okay, so we've identified the risks, we've categorized them, we've seen how returns are calculated to compensate for them. But the goal isn't just to know about risk, is it? It's to manage it, to control it, to somehow minimize its negative impact. How do businesses and maybe even individuals start to actually do that?
Exactly. Knowing about risk is really only the first step. Businesses especially, they must not only identify and assess these various financial risks, but also actively implement strategies to mitigate and control the impact these risks can have on their operations, their finances, everything. It's all about being proactive rather than just, reactive when something bad happens.
So, what's the first line of defense, usually?
Well, one of the most fundamental and widely used strategies for risk management, especially for investors, is diversification. This is simply the process of building a portfolio with investments that have different and ideally offsetting risks. You know the old saying, don't put all your eggs in one basket.
Right. That's diversification.
That's diversification in a nutshell. But maybe think of it as putting a few eggs in a car, a few in a bicycle basket, and maybe a few in your backpack, spreading them across different types of transport, different potential hazards.
Yeah.
Diversification is specifically designed to reduce what we talked about earlier, diversifiable risk, which is also known as unsystematic risk. That's the portion of a single asset's risk that's associated with those random firm-specific causes. By investing in a broad range of assets, different companies, different industries, maybe different countries, if one company or one industry faces a negative event, like a strike or a lawsuit, its impact on your overall portfolio is lessened, because hopefully other unaffected assets are performing normally or even well.
Okay, so it smooths out the bumps from individual stocks tanking.
Exactly. It smooths out those companies' specific bumps. However, it's really crucial to remember what diversification doesn't reduce. It doesn't magically eliminate non-diversifiable risks or systematic risk. Remember, those are the market-wide risks like inflation or a recession that affect almost everything. No matter how diverse your portfolio is, if the entire economy takes a significant downturn, almost all your investments are likely going to feel some negative impact. So the key takeaway here is that a diversified investor should primarily be concerned with that non-diversifiable or systematic risk. Because, at least in theory, an investor can create a portfolio of assets that eliminates almost all of the diversifiable risk. The systematic risk is what remains.
That's why financial advisors are always telling you not to put all your eggs in one basket. It's specifically about spreading out those firm-specific risks. So, yeah, one bad apple doesn't spoil the whole bunch. All right, let's get into the nitty-gritty now of specific strategies. If a company is truly worried about, say, interest rates going up or the whole market taking a dive, what actual concrete steps do they take? What tools are in their risk management toolkit?
Right. This is where the rubber really meets the road. Companies employ many, many different strategies to reduce their exposure and vulnerability to the various financial risks we just outlined. Let's take mitigating interest rate risk first. An investor, for example, could choose to invest in floating rate debt securities. These are designed so their value doesn't change significantly when interest rates shift. Why? Because their coupon payments automatically adjust with the market. When interest rates rise, their payments rise too, keeping their market value relatively stable.
Ah, so they float with the market.
Exactly. Another very common strategy involves using derivatives, things like forward rate agreements, FRAs, or interest rate swaps. In an interest rate swap, for instance, a company might agree to pay a fixed interest rate to someone and, in return, receive a floating interest rate payment from them. This can effectively lock in their borrowing or lending costs, protecting them from adverse rate movements.
Okay, that sounds a bit more complex.
It can be, yes. Derivatives are powerful tools but require careful management. Now, mitigating market risk, that systematic non-diversifiable risk, is much trickier. Because it's inherent in the overall market and economy, you can't just diversify it away.
So what can you do?
Well, there are still strategies. One way is to invest in derivatives that are specifically designed to provide gains when the market declines. Certain types of put options can do this. Another strategy is short selling. This involves selling an investment you don't actually own yet, hoping to buy it back later at a lower price. If the market falls, You profit from that decline.
Risky, though, right, if the market goes up instead.
Very risky, yes. Short selling has potentially unlimited losses if the market moves against you. But let's look at an example from our sources. Imagine Sarah, the CFO of Dillon Bank. She's concerned that falling oil prices might trigger an overall stock market decline in the coming months. To protect the bank's investment portfolios, she might open several short positions in index funds that track the S&P 500. Now, if the market does decline as she feared, the bank will earn a profit from those short positions, and that profit will help offset losses in the bank's other long investments. But as you said, it's a calculated gamble. If the market actually rises instead, she'll incur a loss on those short positions. It's a strategic hedge designed to offset potential market-wide losses, but it carries its own risk.
Okay, so market risk is tough, but there are tools. What about the easier one, unsystematic risk?
Right. Unsystematic risk, that firm-specific diversifiable risk, is much more straightforward to minimize. The primary strategy here is simply diversification. If an investor holds a broad portfolio of investments across various firms, different industries, maybe different asset types like stocks and bonds, then a negative event hitting just one firm or one industry will have a much smaller effect on the overall value of their portfolio. This is really why a balanced, diversified portfolio is almost always recommended. It smooths out the impact of those company-specific shocks.
Makes perfect sense. Now, what about credit risk? How do companies manage that?
Okay, mitigating credit risk. Remember, this is about the borrower's ability to get good terms. So businesses primarily focus on improvements in their credit ratings. Credit ratings are assigned both at the overall company level and for specific debt issues they might release. When a company or its debt has higher credit ratings, it can borrow money at much more favorable terms, specifically at lower interest rates.
So how do they improve their rating?
Well, the rating agencies look at a whole host of factors: the overall economic outlook, conditions in their specific industry, the company's cash flow generation, its leverage, how much debt it has, its capital structure, the perceived strength of its management team, historical performance, lots of things. So management being aware of these factors and actively managing them, keeping debt levels reasonable, maintaining strong cash flows, demonstrating good governance is absolutely crucial to controlling this risk and getting better borrowing terms.
Got it. And default risk, the lender side.
Right, mitigating default risk, which affects the lenders. There are several strategies here. As a lender, an entity might choose to lend only to borrowers who have a very low perceived risk of default. They essentially screen out the riskier potential borrowers. Another common option is to adjust the interest rates charged to better reflect the riskiness of each borrower. So higher risk borrowers pay higher interest rates. This compensates the lender for taking on that increased chance of non-repayment.
So either avoid the risk or charge more for it.
Pretty much. Our sources mention Miller Inc., a company extending credit to its customers. They want to reduce their default risk. They're weighing two plans. Plan A is to reduce their potential customer base by only extending credit to those with really strong credit ratings. Plan B is to continue extending credit to everyone, but charge higher interest rates to those customers who pose greater risks of not paying back the money. Both are valid approaches to mitigating default risk, but they clearly have different impacts on the company's potential sales volume and customer relationships.
Interesting trade-off there. What about liquidity risk?
Liquidity risk. This is typically higher for investments that don't have active, bustling markets. Think certain private forward contracts or maybe limited partnerships in real estate. They can be hard to sell quickly. So, to mitigate this, the main strategy is to allocate a greater percentage of your capital to investments that do trade on active, well-established markets. Things like publicly traded stocks, equities, maybe your corporate bonds, futures contracts, options. These instruments can generally be bought or sold very quickly without having to make significant price concessions. You prioritize holding things you can actually sell when you need the cash.
Okay. And finally, price risk. How do you manage the risk of an individual investment just going down in value?
Right, mitigating price risk. Several strategies overlap here. Like unsystematic risk, diversification definitely helps. If your portfolio holds many different securities, a decline in the value of one particular security has less of an impact on the whole portfolio's value. Price risk can also be mitigated through short selling, as we discussed, profiting from a decline in price, or by using derivatives, specifically things like put options. A put option gives the holder the right, but not the obligation, to sell an asset at a predetermined price, the strike price. This effectively provides a floor, protecting you against the price falling below that level.
Wow, okay. That's a really comprehensive look at risk within a single economy or market. But let's broaden our scope now, maybe go global. When money starts crossing borders, things get even more complex, don't they? We're talking international business, multiple currencies involved. That must add a whole new layer of risk.
Absolutely. It adds a significant new layer. In a purely domestic environment, right, a single currency defines the value of pretty much everything: assets, liabilities, operating transactions. But in international settings, the values of those same assets, liabilities, and transactions are established not only in terms of the domestic currency, but also in relation to other foreign currencies. And this is where exchange rate risk, often called FX risk, comes roaring in. It exists precisely because the relationship between your domestic currency and foreign currencies is constantly subject to volatility, to change. The value of your assets held overseas or the cost of your liabilities owed in a foreign currency can change dramatically, sometimes overnight, simply because the exchange rate shifts.
Okay, so what makes these exchange rates move around so much? It seems chaotic sometimes.
It can definitely seem chaotic. The circumstances that cause changes in exchange rates are generally divided into two main categories: trade-related factors and financial factors.
Trade-related factors first.
Sure, let's start there. The first one is relative inflation rates. If inflation in one country, let's say the US, significantly exceeds the inflation rate in another country, maybe Mexico, then people holding the high inflation currency, the dollar in this case, might want to buy the foreign currency, pesos, to try and maintain their purchasing power. Or, maybe more commonly, if the Mexican peso is suffering from sudden high inflation and the US dollar is relatively stable, Mexicans will likely seek the perceived safe haven of the US dollar. This increased demand for US dollars, which are bought using Mexican pesos, makes the US dollar stronger relative to the peso. The exchange rate moves.
Wow. So a country's internal inflation directly impacts its currency value globally.
Exactly. What's fascinating here is how a country's internal economic health, like its inflation rate, can ripple right out and directly influence global currency values. And that affects everything from import costs to international investment returns. Another key trade factor is relative income levels. As income increases in one country relative to another, people in the higher income country tend to demand more foreign goods and services, and to buy those, they need foreign currency. For instance, if American incomes rise significantly, Americans might vacation more in Mexico or buy more Mexican-made goods like those piñatas we keep mentioning. This increased demand for Mexican pesos, which Americans buy by exchanging US dollars, causes the value of the American dollar to fall in relation to the peso. The currency of the higher income country tends to weaken against the currency of the country whose goods are being imported more.
Interesting. More buying power leads to a weaker currency in a way.
In that specific trade dynamic, yes. It's about the demand for the other currency. Then there are government controls. Various trade barriers and exchange barriers, things like tariffs, import quotas, restrictions on currency exchange, these artificially suppress the natural forces of supply and demand for currencies. And by doing that, they can definitely affect the demand for specific currencies and thus influence the exchange rates. For example, putting a big tariff on imported piñatas would discourage Americans from buying them, thereby reducing the demand for pesos and helping to maintain the existing exchange rate or even strengthening the dollar against the peso.
Okay, so those are the trade factors. What about the financial factors?
Right, the financial factors. The primary one here is relative interest rates and capital flows. This is huge. Interest rates create demand for currencies by motivating investments, either domestic or foreign. The sheer volume of capital flowing between countries has a massive impact. Think about it. Investors always seek the best returns, right? If, for instance, the returns on investments in Mexico suddenly skyrocket, maybe due to high interest rates there, while comparable investments in the United States offer significantly lower returns, U.S. investors are going to find that opportunity in Mexico very attractive. Their demand for Mexican pesos increases dramatically as American investment capital pours into Mexico. This causes the exchange rate to change. The peso strengthens against the U.S. dollar because everyone wants pesos to invest there.
So money chases yield across borders, and that moves exchange rates.
Exactly. Capital flows chase higher returns, and that directly influences currency values in a big way. There's often a tension between the trade factors and these financial factors driving currency movements.
Okay, so exchange rates are clearly always moving based on this huge mix of global economic, trade, and political factors. How does that constant movement translate into different types of financial exposure for a business operating internationally? It can't just be one lump sum of international risk, can it?
You're absolutely right. Foreign exchange risk is typically categorized into three primary types of exposure, and each one impacts a business in a different way. The first type is transaction exposure. This is the most direct, the most immediate one. It's the potential for an organization to suffer an economic loss or maybe realize a gain simply upon the settlement of individual transactions denominated in a foreign currency, purely because the exchange rate changed between when the deal was made and when the cash actually changes hands.
Can you give an example?
Sure. Imagine Seattle Import-Export, a U.S. company. They expect a net inflow of C$2 million from Canada in, say, 90 days. If the current exchange rate is 0.75 US dollars per Canadian dollar, that inflow is worth 100,000 USD right now. But what if, over those 90 days, the rate fluctuates by just 5 cents? If the Canadian dollar strengthens to $0.80 USD, that same C$2 million inflow is now worth 1,600,000 USD.
Yeah.
Great news. But if the Canadian dollar weakens to $0.70 USD, it's now only worth 4,400,000 USD. Bad news. That's a potential $200,000 swing in the value of that single transaction just from a relatively small currency movement. That's transaction exposure.
Wow. That's significant. What's the next type?
The second type is economic exposure. Now, this goes beyond just individual transactions. It's the potential for the present value of an organization's overall cash flows, its entire future stream of earnings, to increase or decrease as a result of changes in exchange rates. This affects the core long-term profitability of the business.
How does that work?
Well, think about currency appreciation or depreciation. If your domestic currency appreciates, meaning it gets stronger, your exports become more expensive for foreign buyers. That could cause your foreign sales volumes to decline over time. Conversely, if your domestic currency depreciates or weakens, your exports become cheaper for foreigners, potentially increasing your foreign sales volume. The overall impact of economic exposure really depends on whether your business has a net inflow or a net outflow of foreign currency and how sensitive your sales and costs are to exchange rate changes.
Okay, so it's about the bigger picture effect on the whole business model.
Exactly. And the third type is translation exposure. This is the risk that the reported financial statements are converted. The assets, liabilities, equity, or income of a consolidated organization, specifically one that includes foreign subsidiaries, will change simply as a result of exchange rate shifts when those foreign subsidiaries' financial statements are converted or translated back into the parent company's home currency for reporting purposes.
So this is purely an accounting issue almost.
It's largely an accounting and reporting issue, yes, but it can still affect perceptions of the company's performance and value. This risk is influenced by two main factors. First, the degree of foreign involvement. The higher the proportion of a company's business that comes from foreign subsidiaries, the greater the translation exposure. Second, the locations of those foreign investments. If subsidiaries are located in countries with very volatile currencies relative to the parent's currency, the translation risk is higher. Stable foreign currencies mean lower risk. For example, our sources compare Domestic International Inc., which just exports facing transaction and maybe economic risk, to Global International Inc., which has 12 foreign subsidiaries generating 65% of its revenue. Global faces significant translation exposure on top of the other two types.
Okay, so if I'm running a business dealing internationally and I'm facing transaction risk, economic risk, translation risk, how do I actually protect myself from these volatile currency swings? It sounds like a minefield out there.
It can certainly feel that way, yeah. But fortunately, there are sophisticated tools and techniques available to manage this. The primary method is called hedging. Hedging is basically a financial risk management technique where an organization deliberately acquires a financial instrument, often a derivative, that is expected to behave in the opposite manner to the item being hedged. In effect, it's a process of reducing the uncertainty of the future value of a transaction or a position by actively taking an offsetting position in something else.
So you're placing a bet against your own risk, in a way.
That's a good way to think about it. You're trying to neutralize the risk. For example, remember Worldwide Sweet Peaches. They buy shipping crates from Mexico and have liabilities in pesos. They're worried the peso might strengthen, maybe doubling their cost by the time the bill is due. To mitigate this transaction risk, they might decide to hedge their position by using a financial instrument to effectively lock in the current peso exchange rate today, ensuring their US dollar cost doesn't suddenly explode if the peso appreciates. Now, before implementing specific hedges, large consolidated entities usually first identify their net transaction exposure. This means looking at the total expected inflows and the total expected outflows of foreign currencies across all their subsidiaries, consolidating them by each currency type and then computing the net effect. Are they net receivers or net payers of euros, yen, pesos, etc.?
So you hedge the overall position, not every single little invoice.
Often, yes. You want to hedge your net exposure, because some inflows and outflows might naturally cancel each other out within the company. And actually, a simpler way for international companies to hedge sometimes without complex instruments is by simply adjusting invoice policies. Maybe they try to time their payments for imports, outflows, to align closely with their collections from exports, inflows in the same currency. That provides kind of natural operational hedge.
Okay. But what about those specific hedging instruments? What are the main techniques for transaction exposure?
All right, let's explore some specific techniques. First, there's the futures hedge. A currency futures contract entitles its holder to either purchase or sell a particular number of currency units, say 125,000 Swiss francs, at a specific negotiated price on a stated future date. Futures contracts are traded on exchanges, they're standardized in amounts, and they tend to be used for smaller, more uniform transactions. So if Worldwide Sweet Peaches wants to pay that peso liability in 30 days, and they're worried the peso will strengthen, they can enter into a futures contract today to buy the exact amount of pesos they need 30 days from now at a price locked in today. This hedges the risk of the peso appreciating.
Okay, locks in the rate. What's a forward hedge? Sounds similar.
It is very similar. A forward hedge also entitles the holder to buy or sell currency units at a negotiated price on a future date. The key difference is that forward contracts are generally private agreements, custom negotiated between a business and a commercial bank. They're typically for much larger, sometimes oddly specific transaction amounts and dates. While a futures hedge might protect one specific standard-sized transaction, a forward hedge is often used based on a broader anticipated company need. Maybe a subsidiary knows it will need to convert a large sum of euros to dollars in 6 months. They use a forward contract for that larger, more customized need. The mechanics for hedging payables or receivables are the same logic as futures, just usually bigger scale.
Got it. Futures are standardized, forwards are custom. What else?
Next, we have the money market hedge. This is a bit different. It involves using domestic currency today to essentially create the foreign currency needed for a future payment, or borrowing against a future foreign currency receipt today. Let's say Duffy's Discount Quinatas owes 1 million pesos in 90 days. Using a money market hedge, they would first figure out how many pesos do they need to invest today in Mexico at Mexican interest rates so that it grows to exactly 1 million pesos in 90 days. Let's say that amount is 961,538 pesos. They would then purchase those 961,538 pesos today using US dollars at today's spot exchange rate. Let's say that costs 76,923 USD. They take those pesos, invest them in a safe Mexican security that matures in 90 days. When it matures, they have exactly 1 million pesos, which they use to pay their supplier.
Whoa, so they effectively locked in their US dollar cost for that future peso payment at 76,923,000 today.
Exactly. They use the interest rate differential between the two countries to create a hedge.
Yeah.
You can do a similar thing if you need to borrow the domestic funds first, or if you're hedging a receivable by borrowing the foreign currency today against the future receipt. It's clever.
Very clever. Okay, what about options? You mentioned those.
Right, currency option hedges. The absolute key feature here is that an option gives the business the right, but crucially not the obligation, to execute the contract. This allows them to choose the most favorable outcome, either use the option or use the market rate, whichever is better at the time. The premium paid upfront for the option is considered a sunk cost, meaning you pay it regardless, and it shouldn't influence your decision later about whether to exercise the option or not.
Okay, so you have flexibility. How does it work for payables?
For payables, where you owe foreign currency and fear it strengthening, you'd buy a call option. That's an option to buy the foreign currency at a specific price, the strike price. Let's say Gertie International owes 1 million pesos and fears the peso strengthening from 0.8 to $0.10. They buy a call option with a strike price of $0.6 per peso, maybe paying a premium of 0.005 per peso, $5,000 total premium. Now, if the peso does strengthen to $0.10 at settlement, the market cost would be $100,000. But Gertie can exercise their option and buy the pesos for only $0.08 each, costing them $80,000 plus the $5,000 premium, so $85,000 total. They saved $15,000 compared to the market. If the peso weakens to, say, 0.07 cents, they wouldn't exercise the option. Why buy $1.08 when the market is there at its own cents? They'd let the option expire, lose the $5,000 premium, but buy the pesos on the market for only $70,000. The option gives them downside protection while letting them benefit from favorable moves.
Okay, that makes sense. And for receivables where you're getting paid in foreign currency?
For receivables, where you fear the foreign currency weakening, you'd buy a put option. That's an option to sell the foreign currency at a specific strike price. So if Gertie is owed 1 million pesos, and fears the peso weakening from $0.08 down to 6 cents, they could buy a put option with an R1.08 strike price, again, maybe a $5,000 premium. If the peso does weaken to bare 08 cents, their receivable is only worth $60,000 in the market. But they can exercise their put option and sell the pesos for 0.08 each, netting $80,000 minus the $5,000 premium, so $75,000. They preserve $15,000 of value compared to the market. If the peso strengthens to $0.09, they wouldn't exercise the put. Why sell at $0.08 when the market offers 0.9s? They let it expire, lose the premium, and sell their pesos on the market for $90,000. Again, downside protection with upside potential.
Options sound pretty powerful. That flexibility is key. What about really long-term deals?
Right. For long-term transactions, there are specialized hedges. You can sometimes get long-term forward contracts, which are mechanically similar to regular forwards, but set up to stabilize transaction exposure over much longer periods, maybe hedging a multi-year purchase contract. Another powerful tool for longer-term exchange rate risk is currency swaps. Here, maybe two firms with coincidental opposite needs for international currencies might agree to essentially swap currencies collected in a future period at a specified exchange rate locked in today. They basically agree years in advance to trade specific amounts of their respective currencies back and forth at set rates. It's almost like a parallel loan structure where firms exchange domestic for foreign currency initially and then agree to re-exchange or repurchase their domestic currency at a later date at the agreed-upon swap rate.
So it removes the uncertainty for long-term cash flows in different currencies.
Exactly. If we connect this to the bigger picture, currency swaps are essentially these agreements to trade money at predetermined rates over an extended period. They can be an absolute lifesaver for companies with significant long-term international commitments, providing much-needed stability against years of potential currency volatility. The calculations can get complex, tracking gains and losses over time, but the core idea is locking in those future exchange rates way in advance.
Okay. Are there any other hedging techniques worth mentioning?
Yeah, a few alternative hedging techniques our sources touch on. One is leading and lagging. This usually involves transactions between subsidiaries of the same company or between a subsidiary and the parent. The entity that is owed money might decide to bill earlier than usual, leading, if they expect the currency they'll receive to weaken, or they might delay billing, lagging, if they expect it to strengthen. It's about strategically timing your internal foreign currency transactions based on exchange rate expectations. Another is cross-hedging. This is interesting. It involves hedging the risk of one particular instrument using a derivatives contract based on a different, but hopefully closely related, underlying asset. This is often done when a direct derivatives contract for the specific currency or instrument you want to hedge isn't available, or if the market for it is highly illiquid. You find something else that moves similarly and use that to hedge. And finally, maybe the simplest long-term hedge is currency diversification. This just means deliberately spreading your company's foreign currency holdings and operations across many different currencies over time.
The idea is that if you hold assets and generate revenues in many different foreign currencies, a substantial decline in the value of just one of those currencies won't significantly impact the overall U.S. dollar value of your firm. It's the classic, don't put all your foreign currency eggs in one basket approach applied internationally.
Wow, okay. We've just covered a really dizzying array of ways to hedge specific transactions, locking in rates for payments or receipts. But what about that bigger picture risk, the overall health of a business with widespread international operations? How do companies manage the broader company-wide impact of currency fluctuations on their entire business model, the economic exposure we talked about beyond just those individual payments?
That's a great question, and it moves us into mitigating economic exposure. Economic exposure, remember, is the degree to which a business's overall long-term cash flows are affected by exchange rate fluctuations. This is especially true when its revenues and its expenses are denominated in different currencies, and this can seriously impact profitability over the long run.
Right, like the piñata example.
It's exactly like Pete's Primo Piñatas. They manufacture in Mexico, so their expenses paid to local suppliers are in pesos. But they export almost 80% of their product to the U.S. and receive revenues in U.S. dollars. If the peso were to strengthen significantly and persistently against the dollar, those U.S. dollar revenues Pete receives would be worth much less in peso terms when converted back to cover his costs. Pete's Primo Piñatas would suffer ongoing economic losses as a direct result of this economic exposure, simply because his revenue currency, USD, is weakening relative to his expense currency, MXN.
So how do you hedge that? It's not a single transaction.
Exactly. The techniques for mitigating economic exposure are fundamentally different from hedging specific transactions. They typically relate to organization-wide issues and can usually only be mitigated with organization-wide approaches. This often involves significant restructuring and adjustments to the company's overall business plan and operations. These are generally much more difficult and strategic moves than just buying a forward contract.
What kind of restructuring are we talking about?
Well, for example, if a company is fearful of a persistently depreciating foreign currency in a market where they sell a lot, meaning their foreign sales revenues are becoming worth less in their home currency, they might strategically elect to decrease their sales focus in that foreign market to preserve overall cash flows. Conversely, if a company anticipates a persistently depreciating foreign currency in a country where they have significant suppliers, they might elect to increase their reliance on those suppliers to take advantage of paying for raw materials or supplies with that now cheaper currency.
So shifting production or sales focus based on long-term currency trends.
Precisely. These restructuring efforts are much more complex than standard hedges. They require a deeper strategic shift in the business model itself. Managing economic exposure is fundamentally harder than managing transaction exposure. And this really raises an important question. Given this complexity, managing these huge overarching currency risks that affect the entire business, what stands out to you as maybe the biggest challenge for global businesses trying to navigate all of this?
That's a great question. Um, what immediately comes to mind is just the sheer unpredictability of it all, right? You're talking about restructuring your entire business based on forecasts of currency movements that are driven by, well, everything: politics, economics, sentiment. How do you actually plan for something that's constantly shifting, potentially dramatically, based on global events you can't control? It seems like it would require incredible foresight, constant vigilance, and maybe a willingness to completely rethink your core business strategy, potentially quite quickly. It sounds incredibly challenging to maintain any kind of long-term strategic vision when the very ground beneath you, the value of money itself, is always moving. Hashtag tag 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 outro. Wow, what a deep dive indeed. We've truly navigated the intricate and sometimes choppy waters of financial risk today. We went from the basic definitions of risk and return, that fundamental trade-off, all the way through to complex hedging strategies involving derivatives and swaps, and wrestled with the profound impact of global currency fluctuations. We've really seen how risk isn't just, a single scary number, but this dynamic, multifaceted force that actually can be understood, measured, and crucially managed.
That's right. We've explored everything from understanding individual risk preferences, are you risk averse or risk seeking, to the massive impact things like relative inflation rates and interest rate differentials have on global currency values. We broke down how a single exchange rate shift can impact an individual transaction or even ripple through an entire multinational corporation via economic and translation exposure. And then we detailed the specific financial instruments companies use, the hedges they employ to try and counter those very effects. I think the key takeaway here, really, is that understanding these mechanisms doesn't just make you well-informed in a passive way. It actually gives you immense power and a much clearer perspective. And that's true whether you're, managing a massive multinational corporation's balance sheet or just trying to optimize your own investment portfolio or understand your mortgage better.
Absolutely. So, thinking about our listeners, what does this all mean for you? Now that you have a better handle on the different types of financial risk, from that inherent market risk that affects everyone to the specific credit risk that affects your ability to borrow, maybe the interest rate risk on your loans, or even just that global dance of currencies we spent so much time on, and now that you've heard about how these risks can be measured and managed, what's one small area in your own financial life? Maybe it's how you think about your savings account choices, or a future credit card decision, maybe your investment mix, or even just how you interpret major news headlines about the global economy, where you can apply this new knowledge, this new perspective on risk to feel just a little bit more in control.